Welcome back to Talk Tickers. This is the show where we stop staring at that confusing mess of green and red arrows on your screen and actually listen to what the executives are saying.
Or in some cases, what they're trying not to say.
Exactly. I'm your host, and today we are looking at a textbook case of good news is actually terrible news. We are decoding the Q2 2025 earnings call for DaVita, ticker symbol DEVA.
And it is a fascinating case study. DaVita dropped their results after hours on August 5th. And if you just glanced at the headlines, you'd think things were great.
Right. You'd think it was time to pop the champagne.
But the market did not agree. It threw a massive tantrum.
A tantrum is putting it lightly. The stock was trading around, $139 before the call?
Yep, up there.
And by the time the dust settled the next day, it was all the way down to $127.
That's an over 8% drop in a single day.
Wow.
And you have to look at the volume, too. I mean, usually DaVita trades maybe, 700,000 shares? Mm-hmm. It's a steady, sort of sleepy healthcare stock.
Yeah, it's not exactly a meme stock.
No. But the day after this call, over 3.3 million shares changed hands. That is institutional conviction.
And not in a good way. That's the sound of big money just running for the exits.
Exactly.
So that is our mission today. We need to figure out why a company that, technically beat its estimates on both top and bottom lines got so completely hammered.
We need to parse through all the noise, the cyber attacks, the mortality rates, and this really weird term they kept using, mistreatments, to figure out if this is a buying opportunity or a falling knife.
Right. We need to dissect the difference between a spreadsheet win and a huge operational red flag.
Because the market, it just looked right past those headline numbers and saw some serious cracks in the foundation.
Okay, let's get into it. But first, let's give them their due. The headline numbers, just to set the baseline, they were actually pretty good, right?
They were. I mean, technically, they were better than fine. Adjusted earnings per share came in at $2.95.
And the street was looking for $2.93.
So a 2-cent beat. GAAP EPS was a bit lower, $2.58.
Still, 2 cents is 2 cents. A win's a win.
And on the top line, revenue was $3.38 billion. That beat estimates by about $40 million.
So up a little bit year over year.
Just a hair, about 0.4%. Yeah. And they generated a lot of cash, $324 million in operating cash flow and $157 million in free cash flow.
See, if I came home with a report card that good, I'd expect a reward. But the market, they basically grounded them.
It's the perfect analogy. It's like getting an A on your report card, but getting suspended from school on the same day.
Ha, right.
The grade doesn't matter if you can't even get in the building. The market saw the A in EPS, but then they looked at the attendance record, the patient volumes, and they just freaked out. Right.
And that brings us to the first major issue. And honestly, a word that just jumped out at me during the call, management kept talking about mistreatments. Now, to me or to any patient listening, that sounds terrifying. It sounds like malpractice.
Yeah, it does, doesn't it? But in the dialysis world, mistreatment is just this really unfortunate piece of industry jargon for a missed appointment.
So a patient was scheduled for dialysis and just didn't show up.
That's it. And since they get paid per treatment, an empty chair is just lost revenue, plain and simple.
And this metric was supposed to be getting better.
It was. There's a whole seasonal rhythm to this business. Usually you see mistreatment spike in Q1, winter weather, flu season.
Makes sense.
Then in Q2, the weather gets better, people get healthier, and they show up. That is the normal cycle.
But that didn't happen this time.
Not really. Management admitted that these mistreatment rates stayed elevated. They came down a little in June, but April and May were really rough. And because of that, they had to cut their guidance.
Yeah, this was the moment on the call where you can almost hear the analysts just sighing into their phones.
It was a drastic cut. They went from expecting treatments to be down maybe 50 basis points for the year to now expecting them to be down 75 to 100 basis points.
And for anyone modeling the stock, that is a direct hit to the whole story.
And it gets worse when you look at what they call same-store, non-acquired growth. That's like the organic heartbeat of the business.
Right, without any acquisitions muddying the waters.
And that's expected to be down roughly 50 basis points.
So why are people missing their appointments? They blame two things, right? A severe flu season, which we knew about.
And the April 2025 cyber incident.
Which brings us right to the second disaster, the Cyberattack hangover.
Mm-hmm.
I have to ask, we're talking about an earnings call in August. The attack was disclosed back in April. How is a hack from 4 months ago still causing people to miss dialysis in May?
That is the multi-million-dollar question. Management's line was that the impact of the cyber event spiked mistreatments, specifically in May.
But what's the logic there?
It's a bit fuzzy. But the idea is that the operational chaos, the communication breakdowns, recovering from a ransomware attack, it just creates friction in the system. Patients don't get scheduled right, new admits get delayed, maybe transport doesn't get coordinated.
So it's the gift that just keeps on giving, in the worst possible way.
It is.
I want to get into the financials of this hack, because the numbers were just shocking to me.
They were really substantial. You have to look at it in two buckets to understand the full impact.
Okay.
First, you have the direct costs. Paying lawyers, consultants, the IT teams to fix everything. That cost them $13 million in Q2. Just Q2.
Okay, $13 million is a lot of money. But for a company this size, it's a line item. It's a bruise, not a broken bone.
True. But then you have the second bucket, the hidden revenue hit. The CFO estimated the cyber incident hit their revenue per treatment by $40 to $50 million.
Wait, hold on, $50 million?
$50 million in lost revenue.
How does that even work? Are the hackers, diverting wire transfers?
No, it's much more boring and much more frustrating than that. It's all about yield and manual processes.
Manual processes? You mean like pen and paper in 2025?
Pretty much. Imagine a Fortune 500 company having to do manual data entry for tens of thousands of complex medical claims.
Oh, that sounds like a nightmare.
It is. Things slow down. Prior authorizations for insurance get delayed. The specific data you need for a perfect claim just isn't gathered in time.
So the insurance companies just say nope and deny the claim.
Exactly, or they delay it. Or the authorization expires. It creates a yield issue. Bad debt goes up because they just can't process the claims efficiently. They're doing the work, the patient is in the chair, but the paperwork is so snarled they aren't getting paid the full amount.
That's incredible. $50 million lost to administrative friction.
And the market hates that. It signals a lack of resilience. It's an operational risk that analysts now have to price in.
Moving on from the cyber mess, there was an even darker stat on the call. We talked about mistreatments, the misappointments, but there's a more permanent reason volume might be down.
Mortality.
Yeah.
This is the grim reality of the business. Mortality rates remain elevated.
And this isn't just a DaVita problem, right? They were pretty clear about that.
No, not at all. This is a national trend, consistent across the healthcare sector post-COVID. Patients are just sicker. Comorbidities like heart disease and diabetes are higher.
The patient population is just more fragile than it was 5 years ago?
That's the post-COVID reality, yeah.
But they're not just throwing their hands up. They did outline a plan.
They did. They called it their three-prong plan to combat mortality. This is where we get into the innovation side of the business.
Right. Prong one was better clearance.
This is the medical tech side. They're talking about using HDF, hemodiafiltration, and middle molecule dialyzers.
Okay, that sounds like some Star Trek technobabble. Break that down for us.
In simple terms, traditional dialysis is great at filtering out small toxins. But there are larger, middle-sized molecules that stay in the blood and cause long-term damage.
Ah, okay.
These new technologies are designed to scrub the blood cleaner. The theory is you clean the blood better, patients feel better, they live longer, and they stay on treatment longer.
Which is obviously good for the patient, but also, from a business view, good for DaVita's volume.
Precisely. Extending life extends the revenue runway.
Okay. Prong two, pharma. Specifically, GLP-1s.
The weight loss drugs, Ozempic, Wegovy, all those.
Everyone is talking about these. What's the angle here for kidney care?
Well, the hypothesis is that these drugs could really help kidney patients by managing diabetes and heart health. If you protect the kidneys by managing the diabetes,
It's a win-win.
it could be. But, and this is a big but, DaVita noted that usage is still very low. We're talking low teens % of their patients.
So it's a potential tailwind, but it's not really blowing yet.
Not yet.
And prong three.
Protocols. Just using predictive analytics to spot when a patient is likely to be hospitalized and then, trying to intervene before it happens.
So innovation here isn't about some moonshot cure. It's about incremental gains to keep patients alive and in that chair.
That's the business model.
Yeah.
It is a game of inches.
Okay, let's pause and look at the scoreboard again. We've got volumes down, we've got cyber costs through the roof, we have mortality up. By all logic, their earnings should have been a disaster.
It should have been.
But they beat EPS. How on earth did they do that?
The saving grace, cost control, or as they love to call it, operational excellence.
This is where the CFO earns their paycheck.
Absolutely. Despite all that chaos, Their patient care cost PCC dropped by $3.50 per treatment, sequentially.
That is a massive move in a business with margins this tight.
It's huge.
How did they manage it? Did they just cut staff?
Actually, the opposite. They improved retention. They stopped the bleeding of staff turnover.
So fewer rookies to train?
Exactly. When you have lower turnover, your training costs just plummet. But more importantly, experienced nurses are just more efficient. They make fewer mistakes. They work faster. They pulled that labor productivity lever harder than anyone expected.
There was one other really weird detail in the cost section that I found. Well, strange. The binder blip.
Ah, yes, the phosphate binders.
These are the pills patients have to take with meals, right, to control phosphorus.
Correct. But management admitted that revenue and costs were both lower because fewer patients were taking their pills.
So patients are just tired of taking a handful of giant pills with every meal, and they just stopped.
They called it adherence issues, but yeah, it's known as pill burden. Imagine having to swallow huge pills 3 times a day, every day. Compliance drops. But financially, it created this weird blip where costs went down because DaVita wasn't buying the drugs, but revenue also went down because they weren't selling them.
So it's a wash, financially.
Pretty much. But it tells you something about the patient experience. It's another little crack in the volume story.
So, to sum up the quarter, they saved the bottom line by cutting costs faster than they were losing patients.
It is a race between efficiency and attrition. That's the perfect way to put it.
And that leads us to the guidance for the rest of the year, the investor context.
This is where the rubber meets the road.
They reiterated their big financial numbers for the full year. Adjusted operating income still expected between $1.92 and $2.02 billion.
And that right there is the risk.
How so? Maintaining guidance is usually a good thing. Shows confidence.
Usually. But think about it. They lowered their volume guidance. They expect fewer treatments.
But they kept their profit guidance the same.
Right, which means they have to cut costs even more aggressively in the back half of the year to make up for those missing patients. They have zero buffer.
They're walking a tightrope without a net?
Precisely. If labor costs tick up or another cyber issue pops up, they miss that guidance.
But they seem confident enough to be spending money.
They're managing the balance sheet very smartly. They raised $1 billion in senior notes to pay down their revolver, locking in liquidity.
And they're buying back their own stock.
Aggressively. 3.1 million shares in Q2, another 2.7 million after the quarter ended. They're literally buying their own dip.
That brings up the elephant in the room, or the whale in the room. Berkshire Hathaway. There was news about them selling shares.
Yeah, the analysts asked, and management shut it down immediately. It was a routine sale, part of a standstill agreement.
Oh, right.
Because DaVita keeps buying back stock, the total number of shares shrinks. So Berkshire's ownership percentage just goes up naturally.
So they have to sell just to keep their percentage flat.
Exactly. It's mathematical maintenance. It is not Warren Buffett bailing on the company. It's just noise.
Okay, so Buffett isn't running away. Good to know.
Don't read into it.
So we have a company fighting a war on, 3 or 4 fronts? Hackers, flu, mortality, but executing brilliantly on the stuff they can control.
It is a battle of execution versus environment.
Which brings us to our favorite part of the show.
The "this is not financial advice" segment.
Quick reminder to everyone listening. We are just 2 voices in your headphones. We are not your financial advisors. Do your own diligence. Don't sue us. But if you were running a hedge fund pod and you had to pitch a trade based just on this call, what's the play?
Okay, I'm calling this one the cyber efficiency mean reversion strategy.
Catchy. What's the thesis?
The thesis is that the market is terrible at pricing temporary versus permanent changes. The stock fell 8% because of mistreatments and cyber costs.
Which are temporary problems.
Yeah, exactly. That $13 million in cyber costs, that goes to zero eventually. The servers get fixed, the missed appointments from the flu and the hack, those revert to the mean. Patients have to go back.
So the bad stuff is temporary, it fades away.
But the good stuff, that $350 per treatment savings in labor costs, that's structural. That's better training, better retention. That sticks.
So the market punished them for a temporary problem and totally ignored a permanent improvement.
That's the trade. You go long DaVita, DVA. You are buying the fear of the hack and you're selling the reality of the grind.
You're betting that by Q3 or Q4, the volume stabilizes, the cyber noise is gone, but that juicy margin expansion from productivity flows right to the bottom line.
You're betting on the tightrope walker making it to the other side. And if you want to get really spicy,
Oh, let's hear it.
you add a hedge. You short the manufacturers of generic phosphate binders.
Because nobody's taking them.
DaVita explicitly said patients aren't adhering to the pill burden. Volume is down. If I'm selling those pills, I'm worried. If I'm DaVita, I'm saving money on it.
Wow.
It's a perfect pair trade.
Buying the dialysis provider, shorting the pill maker. I love it. It's outrageous, it's plausible, and it's right there in the data.
That's where you find the alpha and the footnotes.
Well, there you have it. DaVita Q2 2025. A financial beat that somehow felt like a miss, all overshadowed by a cyber attack that just won't go away.
They're executing on what they can control. Costs are down, the balance sheet is strong. Now they just need the patients to show up.
We'll see you next quarter to see if those mistreatments finally cleared up. Until then, keep listening to the tickers.
And watch those margins.
Thanks for listening, everyone.